So, what is really driving mortgage rates? What we wanted to do is we wanted to kind of talk through mortgage rates. We've seen so much noise around this topic. I've seen a lot of posts, I've seen a lot of videos, and a lot of people are just getting it wrong. So, not that I'm the expert, but I definitely wanted to provide my perspective and provide a little clarity, I hope, on what is going on and what to expect moving forward. So, first and foremost, the Fed does not control mortgage rates. This is something that we get a lot of phone calls when there's a Fed meeting and the Fed lowers rates, that automatically assumes that rates fell 50 basis points when the Fed lowered rates almost about a month ago. So the Fed lowers the federal funds rate, which is the interest rate that banks charge each other for overnight loans to meet reserve requirements. Okay. This is a short term interest rate that really only directly affects credit cards, auto loans, home equity line of credit. So look at it this way. When the Fed wants to slow down purchases of cars and other high ticket items, they raise interest rates and hoping it will slow down spending. And that's what brought down inflation from those record levels, not to where the Fed wants it, below the 2% target, but lowers it enough. Now, let's keep also in perspective the movement in mortgage rates over the last 12 months. So, October of 2023, we were on average right around 8.13%. That's a big move from where we went down to mid September, around 6.15%. Now, in April, rates were right around 7.2, 7.1. And once it became kind of an idea that the Fed was going to be kind of the tone was changing, the bond market started to prepare for that move, and they started to bring rates lower from that low 7% range all the way down to just before the Fed meeting to that 6.15, and we had some, you know, um, rates below even 6%. And I did a video at that time, and I said we have to be very, very cautious at the first Fed meeting. Okay, and what happened was Fed meeting happened, kind of confirmed what the market had already priced in. Well, now the bond market is looking to future expectations. Okay. They do not wait for the Fed. So now that the Fed meeting happened, it was 50 basis points, which was more than what the market was expecting in a lot of cases. And now the market is looking ahead. Okay. And the market's job is to position in anticipation of future Fed decisions. Now, this made it a little bit difficult because now we have an election. And then we had a really, really strong employment report that came out, which also created some volatility. And it's important to know and understand that the market does not wait for the Fed. And in many instances, the market can force the Fed to act because of the movements in the market. So, really, really important to know and understand that. So, let's talk about what's really driving the Fed. The economy is much stronger than expected. So the job market is strong. People are spending a little bit more than what the Fed would like to see, which that keeps inflation high. And in turn, that's what's also pushing mortgage rates up. Okay. The Federal Reserve right now is very data dependent. The Fed wants to control inflation, and many expect rates to go down sooner, which is causing a lot of the confusion. We had a lot of articles written. Everyone was posting that the Fed lowered rates, and all of a sudden rates went higher. It's very, very confusing for the consumer. Okay. But the Fed is going to continue to be data dependent. Now, some data shows that the economy might be cooling off, which should mean rates will go down, but they're still rising. Rates are still moving higher, leaving a lot of people very confused. Okay. So, what are the market dynamics that are driving rates right now? Okay. I think the one piece that is not getting talked about enough, and I think you will see a lot more conversations around this topic in 2025 after the election, is government spending. Okay. Government deficits is a problem. Okay. The US government is running very large deficits, record deficits, meaning they need to sell more treasury bonds to fund expenses. So that means you have more inventory of bonds, and that's not good for mortgage rates. And in the past, we had a lot of countries that would purchase this debt and kind of fund our debt. And we're not seeing the same amount of investment from these other countries. Okay. And that puts a lot of pressure on rates to move lower, okay? Then you also have market sentiment and inflation concerns. So we have inflation above that 2% target that the Fed is looking for, and employment data has surprised to the upside. The last month's job market numbers came in much higher than expected. That causes pressure on mortgage rates. Then we have volatility ahead of the election. And that's not everything else that's going on in the market. We also have an election going on. And there are some concerns over a one-party sweep. Now, why is that a big deal? Because if, one party wins the presidency and another party wins the House or the Senate, not a lot gets done. Okay? If one party wins presidency and has control over the House and the Senate, that means they're going to be passing a lot of legislations, and that means that it's going to be government spending. Spending from both parties is a problem for deficits, and that's what the bond market is looking at. And it's going to be a much bigger topic of discussion if rates continue to move up. And it's important to note that rates could get a lot worse before they get better. Okay? So, what do you do now if you're a buyer? Well, first and foremost, chasing rates can cost you. There was plenty of buyers who could have taken advantage of rates when they were lower and they did not. So the strategy is not about getting the lowest possible rate, but about finding the right mortgage strategy that fits your particular situation. I've had people that I've been working with for the last 2-3 years get offers accepted over the last week or so. So there is a lot of opportunity. Consider locking your rate as soon as possible. Choosing a lender that offers a float down option that can protect you if rates drop after you lock. Work with a team that understands the market. Very, very important. Who you work with matters. This is a professional market. Mortgage strategy matters more than time in the market. And I cannot tell you how many times I get stuff sent to me where the borrower has received really bad information. The shift is a gift. Market uncertainty creates opportunity. There has never been a better time to get an offer accepted since 2019, 2018 than right now. Okay. Inventory is still at record lows. Believe it or not, in Illinois, we're still 62% below where we were in 2019. Illinois is a very different story. I have more concerns about home prices going up than I do going down. And I can share that at a later date, but very, very important. This is what you do now and what you need to think about what's going to happen here in the near future. And this is really important. The first week of November will drive mortgage rates for the next 3 to 6 months. Could be better, but could also be worse. November 1st, we have non-farm payrolls from the previous month, which is going to provide the data that the market reacted last month that caused rates to move up as much as they did because employment came in much stronger. So that data is going to be scrutinized a lot by the market and the Fed. Then on November 5th, you have the election. Okay. November 7th, you have the Fed meeting plus a rate decision and a news conference where the Fed will talk about the market and where they're, talking about. They'll have a press conference where they get asked questions. A lot of volatility can come from that. Then on the 13th, you have inflation. So those first week, 10 days of November are going to be massively impactful to the movement of the market. So very, very important to pay very close attention to what happens here and moving forward. But remember, mortgage strategy always will win over any type of fear of the market or anything else. And right now may not be the best time for you, and that is okay. But I have more concerns that people are going to wait expecting rates to come down. And when they finally do come down, because do I feel rates are going to be lower a year from now, 18 months from now? I do. But I think that move lower is going to be very volatile and it's going to be very hard to time and it's going to be very hard to predict. And if you wait for that, I think it's going to be a mistake because I think a lot of people are going to be re-entering the market and it's going to be much harder to get an offer accepted. And you're probably going to be purchasing at a much higher sales price. So if you have questions, please reach out to me and my team. We'll be around 7 days a week, 7 in the morning to 11 o'clock at night. Thank you.